So to conclude the changes in indirect taxation, our final segment, we have with us Jatin Christopher, partner, JCSS and Associates. Jatin is a chartered accountant, cost accountant, and a law graduate with expertise in indirect tax laws. He's published author and a resource person for ICI and the government. He has been in practice as a partner in JCSS, a full service firm since 2000. Hi Jatin, how are you?
Very well, thank you. Good evening. Hope you had a wonderful marathon session all day.
Yes, indeed. So without further ado, I'll say you to take it forward.
Thank you. Good evening, friends. Economic problems are very complex, and dealing with economic problems accommodates experimentation with lawmaking. And tax legislations have never been strangers to this experimentation of dealing with economic problems. A very wonderful expose on this whole concept of where does the legislature enjoy latitude to experiment with lawmaking to deal with these complex economic problems, and the courts to allow legislature the freedom it needs to do such things. We find Swiss ribbons to give us a very wonderful insight into this aspect. And today's finance proposals that we see are capture this entire aspect of what were the complexities and how has the government attempted to address those in the course of experimenting with lawmaking. When we look at a budgetary proposal, indirect taxes used to occupy center stage almost in the past. And for the last little over 5 years, we've seen the sheen lost as far as the indirect tax proposals are concerned. I'm sure members participating this evening have poured through the notifications relating to customs provisions. I want to bring your attention to one aspect, which is the aspect linked to applicability of these tariff changes and how quickly will these take effect. The provisions in the Finance Bill 126A alone have been notified for purposes of Provisional Collection of Taxes Act 1931. So therefore, the second schedule amendments will take immediate effect. Not that alone, but we also have notifications that have been issued, which come into effect from 2nd of February 2023. So when we're looking at customs notifications, please pay special attention to changes in the first schedule of the customs law, which is contained in the second schedule to the finance bill, and all notifications that have been issued dated to take effect from 2nd of February. When we look at the tariff provisions itself, I leave it for you to consider the changes that have been given effect. But I would also bring you to look at what is being attempted by these changes in the tariff. It points to a certain direction of policy thinking. Broad level changes in the first schedule indicates that there's special attention being paid to sectors which show a lot of promise to take us through to the 5 trillion economy target, to take us through a cleaner and a more responsible economy. When we look at these aspects, I think the direction is very clear as far as how things are being aligned to help us see this nation through to the next phase of progress and development. India is a significant player in the world economy. India continues to lead the way as far as several economies are concerned as to how policy thinking can be aligned and domestic legislations aligned with that policy thinking. Moving from customs into the interesting aspects of GST provisions. Although lawmaking in GST is very complex because of the structure that is put in place in the 101st Constitutional Amendment, the amendments that have been introduced in this bill, in the central GST and the integrated GST statutes, do two things. Just as any amendment, one, it provides us the clarity needed going forward. Two, it admits the absence of this clarity in the provisions up to date. Friends, today we will look at a few provisions from both this perspective, not just to see what amendments have been brought about, but also to see what do these amendments do to the tax positions taken in the past. We have provisions straight away in section 16, the one of those provisions that has brought great grief to taxpayers because of their own, perhaps let's call it lack of insight as far as what these provisions potentially were capable of doing. The tweaking of the provisions in section 16.2 points us in a direction that the government is very resolved as far as matching of credits is concerned. We've seen a slew of amendments in the past. We've seen refinement of those provisions, introduction of 16.2AA. We've seen 43A come in and go. We've seen 36.4, Rule 36.4 come in, get refined as we go along. And today we've seen a complete change in section 38 and 61, Rule 61, to help us come to terms with the fact that matching is here to stay. Matching is here to stay. We've seen a circular 183 issued just at the end of last year, where we saw government bring about this resolve for the past as well. Please bear in mind, friends, when circular 183 makes it necessary for taxpayer to produce a chartered accountant or cost accountant certificate for 1718 and 1819, there was never a rule for those years to accomplish matching. But the circular accomplishes what the law could not. Today, what's happened is tax officers who could examine bona fides of a transaction, today their hands are tied because the circular imposes upon them the duty to demand a chartered accountant certificate for the first 2 years of GST. We have a recent decision in Wipro's case of Karnataka High Court, which says that the instructions in that circular can even be followed for the 3rd year since introduction of GST. Friends, please bear in mind, matching is something that we have to get our hands around and make sure that the ecosystem within which taxpayers operate is refined to only entertain diligent taxpayers, suppliers to work with taxpayers so that we don't have mismatch of credits. It's remarkable of the 4 circumstances that circular talks about. It only contemplates taxes discharged through 3B and not in any other way. And though other than those 4 circumstances, there are plenty others we can think of, but something which a circular skirts to accommodate. Friends, please bear in mind, this amendment here also brings us back to that same position. Have we looked at matching diligently? And what's the consequence when those amendments, when those credits don't match, when we have creditors who we will need to pay? If we have not discharged their dues, what becomes of that liability? Some refinement has been made in 16.2C in the proviso to make sure that it aligns with the refinement we've seen in the rules relating to payment to suppliers. Moving from there, we look at something very interesting in section 17.5. I was just a while ago had the chance to hear Mr. Vinod Kothari take us through the CSR related amendments and how it will have a bearing on the income tax position. He had to but touch upon the GST implications, and I have the benefit of him having shared insights into the advanced rulings that gave the 2 different possibilities here. But friends, let's look at something that's remarkable here. Section 17.5, which contains blocked credits, it talks about certain inward supplies where there is no debate as to the merits of that expense or the purchase, but the credit is going to be blocked nevertheless. The first thing I want to bring you to consider is the placement of this embargo. It resides between clause F and G in a clause titled clause FA. I think there is a lot of purpose why it was placed between F and G. G deals with personal expenses. So therefore, F deals with NRTPs. Placement there brings us to consider that there's some purpose here. Apart from that, if you see the construct of the language here, I don't think CSR spends have been addressed with finality through this proposal. First of all, this proposal is going to get into the statute book maybe 10 months or a year later, because amendment to the central GST law will take effect only when the last of the states bring about amendment to their state legislation. But a year from now, if we set the date, some far more significant amendments will also come in, because we're expecting another GST Council meeting at the end of this month. And among the significant things for them to make a decision, it includes the decision about the GST Appellate Tribunal, dealing with the observations of the Supreme Court in the number of judgments as to how the composition of the bench must be in compliance with R. Gandhi and Roger Matthew and all those decisions that have established the principles to apply. Friends, please bear in mind, there could be a ordinance sometime this year to introduce changes in the central GST law and the state GST law for purposes of activating the tribunal. Perhaps some of those changes will come into effect far sooner than these budget proposals will take effect. So therefore, 17.5 FA, we need to see when it will come into effect. Next, what it does, for the future, credits are blocked. For the past, credits are not blocked. The need for an explicit provision, while the opportunity was there to give retroactivity to this provision, since in the wisdom of the government, the retrospective effect has not been included in this clause. This clause will take effect only from prospectively, and when something so important was required as statutory, an amendment to the statute, this makes it very clear that until now, there is no doubt about admissibility of input tax credit in respect of CSR activity. Those who have got adverse rulings have to go with it, because advanced rulings assure certainty, accuracy being only a byproduct. Looking at exactly the contents of this now, let's say 6 months from now, 1 year from now, clause FA comes into the statute book. All states have also amended their laws. Look at the construct of clause FA. It talks about goods or services used in CSR activity. Please bear in mind, used does not mean used up. So therefore, the one who has made the inward supply, counting this as a CSR activity, he will continue to hold the goods. If he does not continue to hold the goods, but there is a transfer of title in those goods in the course of CSR activity, the transfer is one of the 8 forms of supply. Now let's contrast FA with the construct of another provision. If you see para 1, schedule 1, read with 17.5H and the word disposal used in 7.1A, it will triangulate into a point as to one of the 3 places it will come into effect. So a disposal, when it can be one of the 8 forms of supply, why can transfer not be one of the forms of supply? So without making this any more complex than it already is, clause FA does not deal with all kinds of CSR expenditure. CSR expenditure that is not a supply will only fall within 17.5 FA, which means if it is a transfer of title, because of course it is in the course of business. Secondly, it also has consideration, because consideration is not just increase in assets, it is decrease in liabilities is also consideration. So therefore, this issue has not been resolved, but it does a lot to bring us to pay special attention to CSR activity. Vinodji also mentioned this aspect of certain actors interposing themselves between the donor and the donee in the CSR project. They need to be tremendously vigilant, because they will not come within the exclusion provided in entry number 1 to 12/17, because that is not, these actors in between are not the ones engaging in any charitable activity themselves or engaged in CSR activities themselves. So look at from this point of view, CSR, the issue around ITC and output tax on CSR activity is far from resolved. So we will see some more clarification, not necessarily by way of circulars, but clarification in the language of the law, the scope and its applicability in the days to come. If we look at the exclusion that is provided as far as reversal of credit, previously only transfer of land was brought within the fiction of section 17(3). But today, para 8A has also been proposed to be included, which means goods imported, left in a bonded warehouse, and thereafter sold, although that transaction will not be treated as a supply, input tax reversal will attract on this. But friends, please bear in mind, as far as reversal of credits under 17(3) is concerned, 17(2) is concerned, the reversal is only in respect of common credits. Today, reversal under Rule 4243 is being imposed as if it applies to the entire population of input tax credit, and that is a misapplication of law. One amendment that was being understood and carried through since the beginning was has been introduced now by proposing an amendment to clause section 23, where it starts off with a non-obstant clause, very specifically making it clear that it does not operate in derogation of either 22 or 24. And interestingly, 6 times in 6 years, here is this amendment that goes back, effective from 1st of July 2017. The rest of the section itself is still the same, but the effectiveness of this section is now established. There's no ambiguity any longer that this will not be in derogation of 22 or 23. Some changes have been made, 37, 52, all of those provisions to address the fact that there's a restriction that someone cannot file subsequent month's returns without having filed the previous month's returns. Today, a proposal is made to restrict the claim of the filing of returns to the beyond 3 years. It's now not possible for someone to go about filing those returns. When someone cannot file returns, what is the consequence? Please recollect 62 and 63. 62 allows opportunity for the proper officer to conduct a best judgment assessment under 62. 63 imposes a requirement where a notice could have been given. A notice is given, and then that notice is redressed by a taxpayer providing some response and an order being passed under best judgment provision. So therefore, there is this play of 62, 63 that we have to consider when we look at these provisions. Moving on from there, very quickly, we touch upon section 56. An amendment is being brought in, proposed in section 56, dealing with interest. But it's only a matter of interest that we look at this amendment. But much still remains to be done as far as government being held accountable for payment for belated disbursement of refunds that have been sanctioned. We look at changes to section 122 and then contrast it with some changes in 132. As you know, e-commerce operators were not measurably accountable if suppliers list themselves on the portal, although they have to necessarily register themselves under section 24. Asked the e-commerce operator, and their response was that suppliers are not amenable to instructions by the e-commerce operator unless it flows from the statute. So today, e-commerce companies are not in a position, still, they are not in a position to block these suppliers who are not registered to come in and enlist themselves on the portal. But for allowing such suppliers, e-commerce operator will now be liable to punitive action under 122. So when you look at it from this point of view, it becomes very clear that administration is leaning more towards organized players, and with use of technology, it is far more effective to enforce these provisions through organized players than to pursue suppliers who may not themselves be large enough or organize themselves. So there is a provision e-commerce operators will need to be mindful that when this provision does come into effect, they will be accountable. Gives them sufficient time to start getting their act together, looking out for all the suppliers who are registered, who are not registered but listed, to get them to understand their responsibility under Section 24 and therefore exonerate themselves. But look at it this way: there is a supplier who's registered, enlisted on the portal, and his registration is subsequently cancelled, hopefully not retrospectively. What is the responsibility of the e-commerce operator? When we deal with punitive provisions, please bear in mind, whether there is an express mention or not, there is a necessary ingredient of the required extent of animus. If the operator, if any person to be prosecuted and for penalty under 122, positive action and failure in that action must both be established. Now, when we look at 73, 74, we find provisions dealing with fixed percentages of penalty. Please bear in mind, statute prescribing fixed percentages of penalty does not take away the discretion of a judicial proceeding. If taxpayer does not want to suffer discretion in the hands of the proper officer as far as penalties are concerned, statute prescribes fixed percentages, taking away discretion from a proper officer. But when it comes to a appellate proceeding, definitely the statute only provides a recommended percentage of penalty, but not a fixed percentage. Bringing that principle here, we find that unless e-commerce operators are foisted with that necessary animus, they will not be exposed to a penalty. When we look at 10,000 as a penalty, it may not seem much, but consider the tens of thousands of suppliers listed. And even if we say some percentage of them might not be registered, the penalty can cascade and become a substantial amount. Now look at 132, the amendment proposed. The amendment is to take away 3 offenses listed here, but please bear in mind those 3 were discussed in the 48th GST Council, that decriminalization will be done on those in respect of those 3. But those 3 offenses will not be liable for prosecution, but still be liable for penalty under 122(1). These 3 provisions apart, there is a tweaking that has been made to clause 3 under 132(1). What this provision does, in my mind, is that 1, 2, and 3, all other offenses, clause 3 seemed to sweep all other offenses under its operation. But to me, with this proposed amendment, it brings a lot of clarity as to how 132 should be understood in the past. In the past, prosecution was almost, arrest under 69 was almost barred if the value of offense was below 5 crores. Today, what's happened is clause 3 says the offense listed in 132(1)(b) alone is captured within clause 3. This means that all other offenses below 5 crores, above 2 crores under clause 2 will be liable for prosecution. So there is a great amount of clarity that this amendment brings to what should be the way we should understand these provisions for the past, while it also brings about clarity that except for clause B. See, clause B is very mischievous. Clause B, 132(1)(b) is very mischievous for the reason that it deals with someone who issues an invoice without supply. Mischief. It erodes, it strikes at the heart of a progressive economy that someone will simply print invoices and send it away and facilitate claim of credit. But there are a number of other instances where transaction may present itself in this manner, but it is not something that is designed to perpetrate this offense. So we need to be very diligent about how to look for the ingredients that bring about that satisfy the definition of offenses in section 132. There's still a lot to be discussed about the nature of this amendment being brought in 132, but we'll move on, quickly look at changes may propose to section 138 to lower the limit for compounding of offenses, except the ones that the government is resolute about prosecuting. Compounding also has been, proposal is made to make changes to section 138 so that other than these 3 which have been decriminalized, all other instances with a lower amount by 25%, the compounding fee has been set at that level. We've discussed this in the context of the 48th GST Council meeting. Still some more interesting provisions. 158A, keeping in mind the guidance of the Supreme Court in Puttaswamy's case, 158A makes it now possible for disclosure, exchange of information between various regulatory bodies. Friends, please bear in mind, we have 150 where the information return is not yet notified. We have 151 that came in last year. Again, it's notified, implemented, but there's no order that is issued by the commissioner. Now we have 158A where specific information, of course, consent will be sought. But if you look at the one who is to give consent, it is the benign party to the transaction whose consent is sought. So when you look at it from this point of view, 58A will bring much needed transparency. Friends, regulators will now know, they already do, and this is just one more step in that direction where regulators will know far more intelligent information about taxpayers than taxpayers themselves. Taxpayers have in the past dumped reams of information on the proper officer's desk. Today, with extensive use of technology, information in a very distilled manner will now be accessible to regulators to see what it implies. But let's pause here and consider data analytics can only do that much. Data analytics will present possibilities. It is human ingenuity that still is required to convert that into an allegation, present evidence that substantiates that allegation. Please bear in mind, when we look at any allegation, Section 58 of evidence law makes it very clear that unless it is left undisputed, allegations also can transform themselves and become facts. So taxpayers need to be extremely vigilant not to leave unacceptable allegations undisputed. Allegations left undisputed transform themselves to become facts. And the moment any allegation is disputed, the question of burden of proof springs to life. Tax authorities bear the burden of proof about allegations that they canvass based on a new interpretation that they have thought about, and they need to adduce that allegation, substantiate that allegation with evidence. So when you look at 158A, it's another way in which information can be secured, exchanged with various regulators, but all of them will come and stop at one place and one place only. That is where inferences are being drawn. Taxpayers need to be diligent and to identify whether that inference, has it graduated to even be an allegation, and has that allegation proceeded to be supported by unimpeachable evidence. Please bear in mind, today with the volumes of transactions being looking at, it's simply not possible for a regulator to meet the standards in the law. And this is where GST is a telling example of how rule of law prevails in our country. So the information is there. It's now for the regulator to avail that information and canvass that interpretation that they propose. Taxpayers also need to be diligent about how they run their business. Taxpayers who are doing their business diligently are often blinded by their own innocence. Diligence is not a synonym for innocence. An innocent person also needs to be diligent about how he maintains his ecosystem: customers, suppliers, filing of returns, classification, valuation, reporting of the data in a timely manner. Mere innocence will not cut it. And GST is one place where innocence is discounted so greatly. Innocence is discounted so greatly that taxpayers now have to up their game and make sure that they operate within a very compliant ecosystem of customers, suppliers, and their own distinct entities that they operate within. Another interesting amendment being proposed retrospectively again, we've seen clause 7 and 8 being introduced to schedule 3. Now, here is an amendment that is being made to say that the treatment that transactions in 7 and 8 will not amount to a supply is being given retrospective effect. But look at what happens here. There is a 146, 142. Clause 142 in the bill has clause B, which says, anyone who has already discharged tax under a misinformation that this amendment is only prospective and not clarificatory to be retrospective will not be given refund. Friends, GST is a very forward-looking legislation. It does not look back and set things right for the past. But one thing is certain, taxpayers who were seeking self-assessment, minimum government, maximum governance, GST has answered that ask and said, now you're responsible for your assessment. Section 59, which says self-assessment is the way to go, places a tremendous burden on taxpayers to be diligent about how they will go about making this self-assessment work for them, serve their interests best. So therefore, taxpayers need to be mindful that if they make mistakes in their own self-assessment, it is to their own peril, and no government is going to come in to the rescue of those who are less than diligent about this liberty available in section 59. Quickly, we'll have to look at amendments in IGST law. Simple but profound. Mind you, it is simple but very profound. Amendment being proposed is to the actual expression in 2 subsection 17, where as far as OIDR services are concerned, it simply eliminates one necessary ingredient. It says essentially automated involving minimal human intervention. This expression is sought to be amended. What does it do? It is so innocuous. It is so innocuous that one might tend to just pass it by saying that, yes, it's a simple amendment. Essentially automated and involving minimal human intervention will no longer be required for the transaction to be liable to tax as OIDR services. Friends, this opens up new areas. It opens up new areas where even if it is not essentially automated, even if there is a material amount of human intervention, such a service can be taxed under OIDR services. So therefore, we will need to relook how we have viewed these transactions. What new transactions can come within the scope of this? I just name a few which have attracted a lot of attention in the past. Online gaming, crypto exchanges, information portals. When you have these areas that have attracted a lot of attention, to my mind, this innocuous proposal in the finance bill takes us back to re-examining the tax positions taken in respect of these 3 sectors and plenty others. Friends, please bear in mind, just because the amendment is tiny does not mean it does not have potential. Amendment introduced in section 12(8) to introduce a proviso. Now that proviso is sought to be withdrawn. We have Circular 184 dealing with the consequences of this. To my mind, Circular 184 does something special. It allows supplier to pick a credit efficient place of supply provision. This comes in handy as far as interstate infrastructure construction projects are concerned. I very briefly mentioned what this could be because place of supply provisions in section 10, 11, 12, and 13 of IGST law are only to determine one question: the nature of supply. Taxpayer is nobody to bother about where revenue flows to which state authority, or does it go to the union. Taxpayer only has to apply POS provisions to pick interstate or intrastate. Once you pick, it is not intrastate, it is interstate, and interstate in a manner that optimizes credits to the recipient. So please consider this amendment is significant in illuminating our understanding about that provision. When you look at the overall array of amendments being made, they teach us a lot about the amendments that they themselves achieve for the future, but it also illuminates our understanding for the past. One amendment that is conspicuously missing that I so dearly hoped to find in this bill, which I must bring to members' attention, is a saving provision in 16.4. I'll give just one example. There are 7 illustrations, but only one example I'll present for you to consider. Clubs and associations were brought to tax from 1/1/20 to effective 1/7/17. So in January 22, clubs were called upon to pay output tax from 1/7/17. Are they not hit by 16.4? A consequential amendment should have been made 2 years ago to 16.4 to save clubs and associations from losing input tax credit due to operation of 16.4. To my mind, this year especially, without a saving clause being introduced to 16.4 is going to be the nemesis of 16.4 in the future, rendering the time limit in 16.4 directory and not mandatory. Moving on from there, another interesting aspect that we can see is the CESTAT, Customs Excise Service Tax Appellate Tribunal, being designated as the tribunal to address interstate disputes relating to central sales tax. Friends, as you're aware, provisions were introduced to designate the advance ruling authority of income tax to be the designated authority. Today, amendment is proposed, deleting section 24, substituting section 19 for purpose of section 9 and 6A of Central Sales Tax Act 1956 to make CESTAT the designated authority. We have to wait because it's going to present some very interesting situations where there's going to be 3 parties. There's going to be the taxpayer himself. There's going to be the state which has collected the tax. There's going to be a state which is now seeking to demand tax. Section 6A deals with burden of proof. While burden of proof is one aspect, if CESTAT has to now sit in judgment and preside over these matters, it's going to be so remarkable. It's going to make some very interesting turn of events as to how these interstate disputes will be addressed as far as central sales tax disputes dealing with 2 states seeking revenue discharge already before one authority becoming payable before the other. We will need to await some more consequential changes in the rules to understand how tribunal will function to address these issues, who will be the parties impleaded, if burden of proof has been long, transactions have been concluded long ago, how will burden of proof now be discharged, and if tribunal being the last fact-finding authority can go into inquiry, will they continue to enjoy the power of remand to direct certain facts to be now found out by the original authority? Friends, amendments being brought about in this finance bill in the context of indirect tax provisions are not too little to be dismissed, but too profound for the 2 reasons that we discussed earlier. 1, for what it is capable of doing for the future. 2, for what it also implicitly does for the past. Governance is very complex. Economic problems have to be dealt with, and we cannot lay blame for these amendments, retrospective and refining amendments, at the doorstep of the government, because the government is dealing with really complex problems, and 246A does not give a simple problem for the government to contend with. Therefore, the humility that the government has shown cannot be discounted, because credit, we might find fault with a variety of things that GST law has to presents to taxpayers. But one thing we must admit and give credit where it is due, that the humility that the government shows in being able to being willing to go back and make changes as often as necessary to make it clear that the decisions taken, they are so resolute about it. Faced with a resolute government, which is equally humble about having to make changes, even retrospectively, if you will, we find that the stage is quite well set, that this government is not going to accept any lackadaisical approach in running one's businesses. Taxpayers have for long tried foul that we are not in a position to supervise our suppliers' integrity about how they do business. But I think we've come a long way since introduction, although it's been a short 5 years. But in these short 5 years, the message is very clear that we will need to get our act together, clean the ecosystem within which we wish to operate. Taxpayers who are diligent about their businesses need to understand that here is a law that is the world's envy, because there's no country that could possibly have a legislation as robust as we have in GST, with all our diverse needs that are being met through this one legislation, that no less than a constitutional amendment was required to bring about a legislation as wonderful as ours. It just requires a whole new mindset. We will need to reset the way we look at GST law, because this law upholds rule of law. There's no two ways about it, because we have taxpayers complaining that this law is complex, but please consider for a moment how complex it is for tax administration, not only to grasp the way this law operates, use information that is minimal and available on the portal, not have the power to have intrusive investigations. With all these limitations, the challenge is equal on both sides. The purpose is very clear. Self-assessment in its true spirit is what GST shoots for. And if taxpayers are diligent to understand the responsibility that goes with self-assessment, I think we will have for ourselves a winner in this law and see the potential that it has to offer us in the days to come. Thank you very much. Over to you, Ridhima.
Thanks a lot, sir. I think with council meetings being a mini budget in themselves, thank you for an extensive and a comprehensive session on the proposal in the finance bill. So I'll take a few questions. So would it be okay?
Please.
One second. The first question are, what are the grounds on which we can say CSR would be allowed for the past periods?
The fact that this amendment was necessary is proof in itself that without this amendment, one could not have possibly been denied credit.
Correct.
And then there are scores of others.
Right, absolutely. Next is, what is the purpose of inserting the new provision of Section 158A, and which organizations are expected to be covered here?
Unlike 158A allows regulators to exchange information at a very granular level. So I don't think we can look at 158A as covering large information utilities or organizations that hold significant amount of information. I think individually consent can be sought and information shared with various regulators. So I think 158A is tremendously potent.
Interesting. What would be the implications of change in the definition of OIDR services?
So this is what I was talking about, essentially automated and minimal human intervention being proposed to be taken out. So even if it is not essentially automated, or even if it involves material amount of human intervention, those transactions also seem to come within the operation of the definition. So therefore, we'll have to be careful what are those sectors, because many times to come out of any demand of OIDAR, the grounds used are, look, it's not extensively automated. Look, it does not have minimal human intervention. Now that those goalposts have been shifted, those defenses go away, and transactions that took shelter behind those defenses will now be exposed. That's the risk.
Certainly. So the last question for today, sir. The GST Council recommended to relax mandatory registration requirement for ECO suppliers for composition scheme dealers and unregistered persons. The relaxation is only extended to composition dealers. Is it expected that the relaxation would also be extended to unregistered persons?
See, what happens is, to my mind, service providers don't have any exclusion. There was never any commitment that service providers also will be allowed to get away from this. Where large number of service providers operate through e-commerce, we've seen like ride-hailing services, etc. They have been brought within 9(5) so that there is no leakage of revenue. The necessity is to be registered. I think that doesn't go away. I don't expect unregistered persons to be completely free to sell online, yet not take registration at all. Today, I think it's very clear. Composition is permitted. Composition is permitted, but not unregistered taxpayers. I don't expect that will change. But mind you, when we say composition taxpayers are permitted to list online, taxpayers shouldn't rush to composition, because composition taxpayers are liable to pay tax on the state turnover. It's not only on taxable turnover. So you are in a better position to go in for regular registration with QRMP rather than go in for composition.
Correct.
And I think section 10 will slowly fall into disuse. This is one of those sections that we don't. Government's position was that why do we need composition? Taxpayers said we need composition. Composition has become so stringent and so unviable that soon I would expect section 10 to fall into disuse, although it will stay in the statute book.
Certainly right. So that's it from us. Thank you so much, Jatin, for an extensive and a comprehensive session, ending the day exactly on a high note.
Thank you very much.
Thank you so much.